Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about Radiant Opto-Electronics is that it holds 50% of its assets in cash. This is Andrew Stotz of the Valuation Master Class. Let's get started. This information is for learning purposes only. This is not investment advice or a recommendation. Now, let's start off describing the company here. We can see that this company is in the infotech sector in Taiwan, and it's an Asian manufacturer of backlight modules used for smartphones and laptops with 4 factories and an annual capacity of 160 million units. The question is Radiant Opto-Electronics an undervalued dividend play? There's 3 things you need to know about this company. End markets are mature, means there's no opportunities to grow. The lack of investments translate into 0 revenue growth and a massive dividend yield secured by strong cash generation. This is an interesting company. And I think that the thing that's interesting to me is, would you buy a company that's got no future growth potential? Let's go through it. And welcome to everybody who's coming in on the streams, on YouTube, on LinkedIn, on Facebook. Hi, Nushin. Nice to have you with us. Feel free to ask any questions as we go through it. Let's review some key statistics. First of all, there's 9 analysts covering the company, and they have a valuation of 115 Taiwanese dollars. That's a 13% upside or a buy recommendation. The PE ratio of this company is 7 times, which is very low. And the dividend yield is a crazy 7.9%. That is crazy high. So my value estimate is Taiwan dollars 120. That's a 17% upside, so a little bit more than consensus, and a buy. Now, you must think to yourself, Andrew, you're crazy. Why would you buy a stock that has no growth? Well, that's an excellent question. So let's get into that. First, we have to understand the company a bit. And the company does backlights. This is components and modules, and that's 93% of its revenue. It also has technical support and marketing services, but those are small. 70% of its revenue comes from China, 21% Korea, and only 7% from Taiwan. It's interesting about Taiwan is that it's a relatively small market, so they have got to capture the other markets, whether that's China, the US, in this case, China and Korea. So the share price has been sliding. Basically, it started the year at about 120, and now it's down to a little bit under 110. And the stock price faced a sharp drop by more than 30% in July of 2021. And since then, the stock price has only slowly recovered. I can't remember what happened then, but I believe we also had some tensions going on between the US and China in relation to Taiwan. However, it seems like the 50-day moving average could pass the 200-day moving average soon. Hence, that could turn into a buying signal. The share price has been rising pretty steadily, not, super fast, but from 90 up to about 105 or so right now since about October of 2021. The volume RSI has been strong recently and could provide support for a turnaround. So what's the story? Well, first, the end market's mature, no opportunities to grow. Here, I'm showing a chart of the number of units of smartphones globally and PCs, laptops, and tablets. And in both cases, the lines are kind of flat. And ROEC's revenue is mainly dependent on the growth of the end markets, such as computers, phones, and tablets. A mature market for smartphones translates into a low demand for displays for ROEC's backlights. That's the name of the company, or the ticker code ROEC. The same goes for laptops and notebooks. Now, strong momentum from laptops keeps the sales stable. Here, I show the units sold of the companies of both mobile devices and PCs. And basically, PCs and laptops have been stable and rising over the years, whereas mobile devices kind of shot up in 2020, but then started to crash back down to be more stable. The company's number of sold backlight panels fluctuated around 35 million units per quarter, which is around 88% of its capacity. In the fourth quarter 2021, Backlights for PCs and laptops surpassed mobile devices for the first time. Recently, the company also focused on backlights for vehicles for displays used in vehicles, which could partially offset the declining trend of the other two segments. So let's talk about point number 2, and that is the lack of investments translate into zero revenue growth. This is kind of an ugly chart in front of me, and the chart shows the net fixed assets of the company going down from 7 billion Taiwanese dollars all the way down to the expectation of about 3 billion Taiwanese dollars in 2021. ROEC operates 4 factories with an annual capacity of 160 million backlight panels, and they're pretty close to capacity. They came down in 2020. Obviously, everybody came down. But they're coming back up. Over time, it didn't undergo any expansion, and it is likely to not do so in the future as well. Wait, no expansion. This means that the company faces flat or declining revenue. So why would you invest in a company that's flat or declining revenue? Well, I think one of the things that I would highlight is that not every stock in your portfolio is going to be a 10-bagger. In fact, we've looked at a lot of companies, and not many of them would go up by 10 times or even 5 times. But sometimes you need something solid in your portfolio, and there's a reason why this could be interesting. Welcome everybody into the Valuation Master Class case study. I see Steven is here. Nice to have you here. Lee's here. Notion's here, and all the others who are online. Great to have you. Let's continue. Number 3 is cash machine ensures consistent, massive dividend yield. Now, while the company is likely to face stagnant revenue, it is a mature cash machine. It consistently delivered strong free cash for the firm that were more than sufficient to cover high dividends. On top of that, the ROIC holds more, the company, ROEC, not to be confused with ROIC, ROEC holds more than 50% of its assets in cash. And that is a phenomenally high amount held there. Now, in the chart that I'm looking at the cash as a percent of assets. It's been about roughly 50%, even more than 50% over the years. And free cash flow to the firm has been around, let's say, ranging between about 5 and 7 Taiwanese billion dollars. So what is free cash flow yield? It's a measure of how much free cash flow the company generates annually relative to the company's size as measured in market capitalization. Remember, market capitalization is the price times the number of shares outstanding. Now, here's the calculation for ROEC. The free cash flow yield is the free cash flow divided by the market cap. 5 billion right now that we're expecting in free cash flow to the firm divided by the market cap of 47 billion. That's 11%. The free cash flow yield shows ROEC's dividend paying potential. Now, with an 8% dividend yield, the company is paying slightly below its potential. It's a good lesson here to think about free cash flow. What is free cash flow? I always like to say that it is the theoretical amount of dividends that a company could pay. If the company's paying no dividends, you could use the free cash flow to try to figure out what is the potential. The reason why free cash flow is sometimes very handy when you're taking over companies is because when your free cash flow is high and your dividends are low, someone may want to take over the company. And then when they do that, they could start to issue large dividends. Here could be a takeover candidate sitting on 50% of its assets in cash. Thank you, Tada, and also Amon Rat. Welcome. Yes, the cartoon character is even more handsome than I am. Now, the market might place too much weight on the lack of growth and overlook the company's consistency. So, there's some people that say, look, if there's no growth, I'm not investing in the company. But let's just look at the dividend yield here. We can see that the dividend yield has maintained its high level for like 5 years already. So it's not like this is a one-hit situation. Also, the company's return on invested capital is massive. It's ranging between 50 and 100%, meaning it's way above the weighted average cost of capital. Recently, the dividend yield grew to 8%, which is 4 times higher than Taiwanese average. Even if the company does not generate any growth at all, the dividend yield alone might be attractive. And given its low investments, the company delivers an astonishingly high ROIC, which is more than 6 times higher than its WACC in 2021. So super profitable company. Yes, not much growth, but they're paying a lot out in dividend, and they've got 50+% of their balance sheet in cash. Tirapat, nice to see you. Welcome. So remember, you can scan this QR code to go to the valuationmasterclass.com blog to download all full case study reports for free. If you're watching this, if you're listening to this, all you have to do is go to the show notes, and I'll have the links down there. Now, I see Lee is saying, let's just see what Lee is saying here. Lee is saying perhaps there could be some growth in their virtual reality products as the metaverse grows. Exactly, it's possible. But here we're valuing it. I'm going to show you in a minute, Lee, that we're going to value it as if there is simply no future long-term growth. And if you could say that the growth could pick up from virtual reality customers, then it's even better news. Let's look at the company's FVMR scorecard, which measures the stock's attractiveness relative to all other companies. And that attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. And it's from a scale of 1 best to 10 worst. The company ranks pretty well on most of them. The worst case is momentum, where it's a little bit lower, but still is a positive. But let's look in the fundamentals a bit to understand this company. The net margin, the recurring net margin, is about 11%. That's a fantastic net margin when you consider the average net margin of all companies worldwide is about 6% over the long term. Also, return on equity is at about 22% in the past 12 months. So pretty good numbers there. Now, recently I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan the QR code or go to the link down below. So let's talk about the forecast. Again, there's 9 analysts covering the company. The upside is 13%. Most analysts have issued a hold recommendation, while 4 recommend a buy. None of them recommend a sell. That's interesting when you say revenue is basically flat. Consensus expects declining revenue. In fact, it's worse than flat. In 2020, the company had 0% revenue growth. In 2021, it had 1%. 2022, analysts are expecting -3%, and 2023, -4%. And fact is, this company's never grown that super fast, but also even in 2020, it didn't even go to a significant negative item. It just went down to 0. I had to get a drink there. Still, the analysts expect the company to maintain its great margin, delivering consistent profits over time. It's just a very stable business. Let's look at the P&L here, and we can see the company's likely to continue delivering strong and stable profits. It's a very simple company. It's not that complicated, and I like that. Revenue could decline slightly as some display manufacturers like LG shift to OLED, but so what? The cash holding of the company is 50%, actually even more than 50%. So it's massive as a percent of total assets. And still, the company has no plans to use the cash for investments. In fact, we can see the net fixed assets is a tiny amount of their overall balance sheet structure on the asset side. So what about liabilities? Well, the company has almost no long-term debt, though it does have some short-term debt, leading to ultimately a negative net debt to equity of 0.17. When a company has a negative net debt to equity, that means that it's a net cash company, ultimately a net cash company. Stephen, thank you. I appreciate that. And Stephen says, great presentation. And also, I see that Tiranan says, great. All right. So let's continue on and let's look at this for a moment. The dividend payout ratio is about 60 to 70% almost. So it's very high. That's typical of a growth company. You would expect that. And EBIT margin is about 13%. That's also high relative to the average EBIT margin of about 10% worldwide. Now, if you want to learn how to value companies like this, check out my 6-week online Valuation Master Class Boot Camp. Class starts on March 7th. It's practical. You'll learn practical stock valuation skills and apply them to value actual companies like this. You'll access the tools tips and tricks I use to become a #1 financial analyst. You'll join a group of inspiring, like-minded financial professionals, and you'll get a job through my network of thousands of financial industry leaders. You can save $400 until February 28th by scanning this QR code to learn more and register to get the full curriculum, or just go to valuationmasterclass.com/bootcamp. The bootcamp is tough, but if you can pass it, you've learned a hell of a lot. Let's go into valuation. We're going to review the Stotz Investment Research Stock Picking Checklist. It was inspired by Peter Lynch's book, One Up on Wall Street, which talked about 10 baggers. That's a stock that's gone up 10 times. Based upon our extensive research, we've come up with a scorecard. There's 9 factors that drive long-term share price performance. So let's review the company's potential to see, could this be a 10 bagger or a 5 bagger? Management. The first one is management. Management has a proven commitment to growth. The answer to this is weak. Revenue remain almost constant over the past few years. There's no capacity expansion that is planned. And next, growth. The product and industry can support a decade of 10% plus annual growth. Weak. End markets, meaning smartphones and laptops, have become mature. Number 3 is sustainable. The competitive strategy creates sustainably high gross margin. Moderate. Competition is intense and existing players are challenged by low-cost manufacturers. Number 4 is quality. Good earnings quality. Non-core items are small or non-existent. Good. There's low fluctuation in the earnings. Net profit has been consistently positive. Efficiency is number 5. In the long run, sales grow faster than assets. This is weak. Production capacity has a ceiling. Investments in new factories won't be required to grow right now. Number 6, tight, relatively low cash conversion cycle. Negative is best. Moderate. Cash conversion cycle is moderately high and stood at 28 days in 2020. Number 7, cash flow. Operating cash flow is consistently positive. This is good. The company is a cash flow machine. Number 8, capacity has access. Does the company have access to capital to fund its growth? Good. It has 50% of its assets in cash. It could acquire a company. It could expand its manufacturing operation. It has so many options without even needing to raise capital or to borrow any money. Inexpensive. Valuation is reasonable. Of course, we want to avoid very expensive stocks. This is good. The company trades cheap on both PE and price to book compared to the Taiwanese infotech. It's got low growth, but man, does it have high returns. Let's look at the free cash flow of the company. The free cash flow has been consistently positive, which is important to secure the attractive dividend yield. In fact, we'll look at free cash flow. So the forecast assumptions that I've got is revenue growth is going to be a -2%. And I'm pretty much in line with other assumptions of analysts. So given the lack of investment plans, I set the terminal growth to 0. And Lee, this is what I was talking about how do we deal with a company that doesn't have growth? Well, we've already because we are valuing the company using our value model, we've already gone in and shown that the revenue growth is going to be negative over the next few years, what I call the discrete period. But here now we can see that the terminal growth, I'm going to say there is no growth for the company going forward. So that's a pretty punishing assumption. But, until we get an announcement from them, I think it's a reasonable assumption. The cost of equity is 9. The WACC is 7.8. So let's see the free cash flow. Again, I come up to $120 of Taiwanese dollars. That's a 17% upside. My bull case brings it to 28% upside, and my bear case to -7%, to 7% upside. So all upside. Let's review the company's WorldClass Benchmarking scorecard. We identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth, and the scale is from 1 best to 10 worst. Here we can see when we benchmark the company's profitable growth score against 700 large infotech companies, it was in 2018 and 2019, it was ranked world class. That means it would have ranked number 1 or number 2. And it's come down slightly to 3 for profitable growth, but still that's above average. And here we can see that the profitability is also ranked at a 3. The profitability is almost mirroring what we're seeing in a profitable growth, and the growth is suffering. It's down in 2000. Let's go back to 2017. It was highly ranked at a 2, but then it went down to a 3. Then it went below average to a 6, then deeper below average to an 8, Now it's rebounding a little bit in the past 12 months to a 7, but that's still a couple of percentage points or a couple decile points below what the average is. What are the risks? Well, the key risk is intensified price competition. Low-cost competitors from China could pressure the companies to reduce prices. And if you have falling output or flat output and falling prices, that could be bad. High customer concentration could be dangerous, and the failure to keep up with technological changes. The conclusions: management has no alignment to growth, revenue remains flat, but the strong balance sheet and cash flow generation secure a massive dividend yield. Valuation is expensive, but making an interesting value or dividend play. So my question to you, are you ready for it? My question to you is Radiant Opto-Electronics an undervalued dividend play? Feel free to share your answers to that question in the chat below. Have a great